Welcome back. Sebastian, I want to talk about housing in Canada because most of our wealth is tied to it. In fact, a lot of our GDP growth is exposed to it. And people are vulnerable because of higher rates, but also because of our mortgage and amortization rules that are different than the US. What's the housing picture telling you, and how big of a risk of a downturn, if you're expecting downturn, could that have on our economy?
Well, I don't think that there's a housing bubble in Canada. We did our studies here. We dug deep, and we think there is some fraud. There is a context for adjustments of the prices lower. We can even go to -20, -30% from the recent highs. This is something that we've considered and that has significant probability, but still that would not be a bubble bursting, because a
Mhm.
bubble bursting, we've seen what it was in the US in the 2000s. It's not the same thing. Demography is behind a lot of the move upwards for the price of houses, and is in Canada. It also gives us a strong foundation. But of course, uh, rock bottom rates push prices higher, and as we normalize monetary policy, we need to expect prices to fall. And it's a good thing to have an adjustment and not have a bubble that continues to go larger, as we've seen in the US in the 2000s. So as you mentioned, it's about the wealth effect. Households will feel less willing, less confident to continue spending. And recession is nothing else than people keeping their money in their pockets. So we could have that as a very strong factor explaining why 2023 could be a year where very low GDP growth, or maybe negative GDP growth through the year.
Okay. Can you talk about the tone and focus of the Fed versus the Bank of Canada? How different are they, Sebastian?
Well,
And also, can Tiff Macklem actually march to his own beat, or does he have to follow along with what Jerome Powell is doing just because of the proximity, to us being next to the biggest capital market in the world?
Well, I think Mr. McClellan will have the luxury to march to his own beat at some point in 2023, maybe in the second half of the year, when the tightening is done and central bankers tend to agree pretty much H1 2023 that it's enough with the hikes. Now it's time to keep rates elevated for a while. And the a while part will be different for Canada and the US. Few things: if Canada's economy is more resilient with its labor market than the US economy, this is what we're thinking. Even though housing could be an issue, and the labor market here is very strong, very resilient. The demographic impact that we have in Canada makes for a stronger economy. So we think maybe at some point the Bank of Canada will be able to start cutting earlier, and also with inflation forecasts for Canada being a bit easier than in the US, maybe we have some options in 2023 at the Bank of Canada that they don't have in the US at the Fed.
Okay, yeah, and we're showing this terminal rates chart. What is that showing us? If we can bring that back up.
Sure. So it's telling us that the market is expecting the Bank of Canada to be done with hiking at about 4.5 to 4.75. So here it's between the two. And the US, they'll be done at about 5%. So it means that there's probably one hike coming for the Bank of Canada. We think it's going to be on January 25th, because of the latest labor report that was very, very strong. And the strength of the Canadian economy is stronger than the Bank of Canada was expecting. So I think they go in January. For the Fed, there's a few more hikes coming, but the Fed is de facto the world's central bank. And if they're so important for financial markets, that likely they need to stay on the sidelines longer to make sure that inflation, is under control before they start pivoting. The Bank of Canada has the luxury to start pivoting before.
Okay. Again, another minute till the next break. I want to switch gears and talk about bonds, Sebastian,
Mhm.
because fixed income has had a brutal year in 2022. It looks like things are turning around. Is that a correct assumption?
Yeah, we would expect 2023 to be positive for sovereign bonds. So this is our call. It's very early in the year, but we're expecting that. We think rates could be range bound through the year as the economy slows down. Inflation also slows down, but the prospects for growth are getting better because inflation is under control. So all of these things together means that the coupon is interesting. We could have some capital gains if we have a recession, meaning rates get lower and you have, through the year, some bouts of good performance from sovereign bonds. But yes, following a tough year or 2 tough years, 2023 could be, in the green.
Okay, we'll take another quick break. We'll be right back.